Hello, everyone. We have another great episode. My name is Seewing Yee, and my co-host is Mr. Richard Advani, one of the nation's leading real estate investment loan advisor. Welcome, Richard. How are you?
Doing well, thank you.
Today's topic, Richard and I are going to talk about the headline from a Financial Advisor magazine article authored by Patrick Clark. The headline is Real estate investors are wiped out on bets fueled by Wall Street loans. My particular thumbnail article name for this particular presentation is Nightmare on Wall Street. You heard the movie Nightmare on Elm Street? Nightmare on Wall Street. What year was this movie was made? Back in 1980s? Richard, remember Nightmare on Elm Street?
Probably even earlier than that,
Yeah,
before my time.
yeah, before your time. Exactly. I remember that movie when I was a teenager way back. I don't forgot what year. This is the Nightmare on Wall Street. So what I mean by that, okay, let's dive deep into it. So we are talking about Wall Street. They have been entering the real estate game ever since the last housing crash in 2008. So Richard and I do remember back in those days with all the hedge funds buying into the residential real estate market in the Sun Belt from 2008. They are not a major player yet. Maybe they own 2 or 3% of all the single family home, residential homes in the Sunbelt markets all over the South and Southeast and Southwest. But today we can talk about the commercial potential crisis. So here it is. So Wall Street securitization machine and sharply higher interest rates also shows how the fear of missing out, FOMO, and easy money once again combined to burst an American real estate bubble. Wow, sounds very scary. Okay. Scary headlines always bring in interest. So this article, this is right here. Much of the worry over U.S. commercial property has legitimately centered on the office market, where more than 38 billion in buildings were in distress as of March of this year, compared with about 10 billion for apartments, according to MSC. As we go down here, this is speculative fix and flip deals, levering up with loans that were often then packaged as securities and sold to institutional buyers. It's an echo of the subprime mortgage boom that led to the 2008 financial crisis. Uh, a lending model built on packaging seemingly safe loans for borrowers with short track records and small down payments. So my takeaway from this paragraph, Richard, is that the commercial lenders that enter the market several years ago, they are they're not a very they don't have a track record. So they enticed a lot of small investors to invest their money into the commercial loans using bridge loans, using adjustable loan and with debts. And then when the loans need to be refinanced, now in a much higher interest rate environment. So that's my takeaway so far. So what is your quick takeaway from the information so far?
In general, the commercial industry for commercial properties, as well as the commercial loan market, are really tied in together, right? The value at which people can exit these commercial properties is greatly influenced by the rate market because they sell in multiples of their cash flow, essentially, right? So the more profitable a commercial property is, the more it can sell for. A lot of people purchase these properties with the intent of selling them in the near term, and they took low rates on adjustables or balloon type loan products, and now those loans are coming due. The problem is not only that, hey, interest rates are higher today, but with those higher rates means the overall performance and profitability of the property goes down, which if you listen to what I said a minute ago, that means the price goes down. And that means a lot of these people are upside down. They can't even sell the commercial property and they've got to restructure with the lenders. And yeah, there's definitely some turmoil happening in that side of the market.
That's right. That's right. And yeah, that's right. That's what's happening. All right, let's go on. The troubles in commercial real estate are not only deepening as high interest rate persist and loans come due, which you already mentioned. So let's go over the pandemic boom times paragraph right down here. At the time, the apartment industry was on a wild ride as investors sought to take advantage of rock bottom interest rates and soaring rents. In the fourth quarter of 2021, a record 166 billion worth of US apartment buildings changed hands, more than 3 times the pre-pandemic normal. Further, real estate syndicators, yeah, which are, you and I know, there's a lot of syndicators several years back during the 2021 and 2020. They were not experienced. They entice, they talk a good game. They know how to market their syndications, and a lot of people jump in, and this promise of outrageous return, the pipers coming down the pipe, they pull money from affluent individuals to buy properties. These syndications are going after the affluent market, right? People with six-figure income package the money together and then enabling investors to benefit from rising values and rents without having to deal with the headaches of renovation and financing. Look, if these affluent individuals, they are so busy with their lives and career, whatever, they perhaps they don't want to buy income properties where they have to self-manage or even property manager. So they want these working individuals, as busy as they are, they want 100% passive investment. They're gonna provide a chunk of their savings and put it into syndication, and that's the problem with having right now. When we go 100% passive, when you do not do enough due diligence on syndication, you don't go over their background or lack of track record, so you have not done the proper due diligence and research for those people that are affected by this stress situation as we're experiencing now. So, furthermore, leveraging technology to build empires of Airbnb, vacation homes, self-storage facilities, and multiple apartments. So these syndicators, they use these underlying assets, these asset classes to syndicate, package it up using short-term debt, knowing, like you said, they have to refinance out of those short-term debt in a high interest rate environment, and that is a recipe for disaster. I think the final article right here, maybe not the final. Right. So the next paragraph is perfect cocktail. What do we mean by that? Perfect cocktail. The idea of pulling money from multiple investors to buy and manage real estate is a whole one. Yeah, of course. And again, the bridge loans syndicators, okay, they are the ones that are doing all this. So the loans that they're doing at the beginning was usually flexible terms, right? It's not a fixed 30-year fixed rate mortgage like you get in the low risk residential investing, the kind of loans that you do. But the commercial loans is volatile, is risky, especially on this challenging environment. So syndicators, quote, got shorter maturities and variable rates. Wow, it's not going to end up well. So this professor from Columbia University who studied real estate said he's a perfect cocktail of a problem. So you have any kind of what's your interpretation of the word perfect cocktail of a problem? You have any thoughts?
Yeah, they're obviously talking about the inexperienced syndicators mixed with financing that they really didn't understand as much, or the implications of the financing. It is definitely a perfect cocktail, right? As these interest rates continue to be high and these people can't get out of the short-term debt they had, they're going to have to sell sometimes at a loss, which means a loss for everyone that invested in that syndication also. And there are a lot of great syndicators out there, but there also are a lot of inexperienced ones, like the article alludes to. And apartment syndications, as we both know, have blown through the roof the last 2 or 3 years, right? There's tons of people investing in them. And we were in a market for a long time that you couldn't lose at all, no matter what you bought. And that's changed. The inexperienced people are definitely going to get burned a little.
Yep, I agree. All right, so let's continue. Okay, let me see what else. Okay, down here, by June of 2022, a couple of years ago, exactly 2 years ago, to this day, all sorts of trouble began to appear at once. The Federal Reserve has started hiking interest rates at the fastest pace in a generation. Yes, I know we went through that. So sales of apartment buildings plummeted to 28 billion in the fourth quarter of 2023, down more than 80% from 2 years earlier, according to MSCI. So let's come down here with this highlight. With loan payments soaring and capital for renovations drying up, they risk losing buildings to foreclosure or selling at a loss, with equity investors typically last in line for payment. What do you
I
think?
swear I didn't read any of these articles before. I feel like I keep leading up to the next article and what I'm saying. Yeah, this is what we just discussed.
Yeah, okay. Over here, with equity investors typically last in line for payment. My takeaway for that is once the syndication sell their assets, maybe at a loss, they may or may not keep some of their profits, and any profits remaining, then the investors last in line. That's not a good thing, because last in line to me means it may not be any profit. If there's a loss, last in line for all those investors, they're gonna lose money. They can crash and burn. So what are your thoughts on this method of payment when the syndication group belly up? You have any thoughts? I mean,
No, just kind of what I shared in this in the article just shares that sentiment, that perfect cocktail of doom, for lack of a better word, is going to cause investors to lose money. And it's all a lot of times due to, obviously, look, the changing market and where rates are. But a lot of these inexperienced indicators didn't have an exit strategy other than refinancing that loan.
exactly. See, that's what you get when you have Wall Street try to enter Main Street, right? Wall Street, these hedge funds. Do you know this hedge funds owners, the general partners? Some of those successful hedge fund individuals, they have a $10 billion of net worth, right? When these hedge fund owners that run the syndication, when the syndication makes a lot of money, they take a lot of profit to put it in their own pockets before they pass it on to an equity investor. As we alluded to, equity investors get paid last, and those hedge fund owners, general partners, they get paid first. That's why whenever you look at the every year, I think the Forbes magazine come out with the richest billionaires out there, billionaires. A lot of hedge fund individuals, they are on the top 100 list of the wealthiest billionaires in the world, because they take a lot of risk, and if they do well, they pocket a large percentage of the profit before they pass any remaining profit, pass it on to the end user and investors, like the last in line. The equity investors get paid last in line if there are any profits left, right? I don't know. All right, okay. Higher interest rates continue to bite, with rising property taxes and insurance premium making things worse. You and I know there's a lot of headlines information out there recently about the rising property taxes and rising insurance premiums, especially in those weather affected high-risk coastal markets all over the country, like the Atlantic coast, the Florida coast, and the Gulf Coast, and even the California coast. A lot of insurance companies are raising the insurance due to the weather situation. So let me see, anything else? Okay, here's the final thing. Another comment, the final comment. She's now watching her portfolio for more trouble. This person says, okay, nothing else. All right. Okay. So my quick takeaway for this presentation, Richard, is that the commercial crash is coming. It's not going to happen all at one time. These defaults, the lagging effect for the next 1, 2, 3, 4, 5 years, we will see some commercial defaults and assets coming down the pipeline. But I do not believe the commercial default stress crisis going to transfer into the other listed markets, such as a single-family home, nothing like that. So it's a totally different asset class, right, Richard? But takeaway is the commercial crisis.
My phone went for a tumble, sorry.
I understand. So the commercial asset class, these are very compartmentalized asset class. So it's not going to affect the economy that much. It's not going to affect the residential investing asset class, I don't think, so far. So what do you take away from this article? Final thoughts.
I don't know why anyone would syndicate. There's so many good opportunities to own single family 1 to 4 unit investment properties where you're 100% owner. And obviously, as we know, residential financing is the best financing out there, right? The main reason people are running into these problems on these commercial loans is the fact they don't have 30-year fixed rates, which residential properties do. And obviously, when you work with a group like Seewings, the normal complications and stress that comes with buying out of state real estate isn't there. You're able to purchase cash flowing turnkey real estate with management in place and everything else. Look, in my mind, there's no reason to syndicate when you can accomplish the same thing on your own. Now, if you've got 40,000 to invest, you could probably still buy some investment real estate. But if you have a very small amount to invest and that's your only way to enter the real estate market, syndicate. But that article is talking about a lady invest $1 million of her husband's 401k. And it's like, why didn't you just directly buy real estate with that $1 million, right? At 25% down, you could have bought $4 million worth of real estate. Instead, you give it to someone else to invest in a product that has not a fixed rate, and a product that's really driven by interest rates, commercial buildings, and so forth.
Yeah, that's a lesson learned. Richard, you and I have been doing this for a long time, right? And yeah, at the end of the day, is each individuals out there, each investors out there, and you have to determine what is your buy box, quote unquote, buy box. You have to you have to ask yourself. You can't go. There are so many investment options out there. Your box, my box is very similar, right? Buy single family home, duplex, up into 4 unit, get residential. Fannie Mae lending guidelines, 20 to 25% down payment, buy in a good market, cash flow market, South and Southeast, and in the Midwest. And then invest directly, invest 100% into something, an asset you can control, buy with your name. Don't need to partner with anybody. Don't need to do syndication. Don't need to, you need to control your asset. Controlling your asset is buying single family home, residential investing, duplex, triplex, fourplex, 100% under your name. Do not partner. Okay, when you partner with somebody else, partners or even syndicator, or they're not reliable. You cannot control them. They could be scams. There could be shysters out there. So control your asset 100%. Buy with 100% under your name, getting your loan under your name, your FICO score, your W-2 income to qualify, or buying a self-directed IRA 100%. Using your IRA to buy in hard asset investment real estate. Don't partner, don't do syndication, because those are, I call it those are not luxury. Those are popular stuff. People, you buy boring income properties. Boring over time will create wealth. Don't fall into the exciting trophy investment strategies and go through all the hype. So anyway, that's all I have to say. Thank you everyone for watching, and receive any value from this video, please like and subscribe and comment below. And also, if you have not already done so, put your email on my website below so you can receive email newsletters about investment opportunities through your email inbox on a daily basis. So you can become a risk investor and then take action to achieve your wealth for yourself and for your family. Thank you so much. Have a nice day. See you next time.